Hey, good morning to all of the options traders out there and happy hump day. Today is our first video for September 2024. And I got an email from one of the traders in our group asking for a quick review of the Greeks. Not super detailed, but just to give a quick overview of how to interpret these numbers that we see on our brokers' platforms. What do they mean? How should we interpret them? So sure, why not? Let's go have a quick review of the Greeks. And as always, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So what are these things that we call the Greeks? Well, they're represented by Greek letters. That's why they're called the Greeks. But they're simply sensitivity measures. Sometimes people call them risk measures. That's fine. We're going to find out that there's one that really isn't truly a risk. So I prefer to say that they are sensitivity measures. They're just telling us how sensitive our options are to certain other factors. So the five Greeks that we have that we're at least going to talk about in this video are delta, gamma, theta, vega, and rho. Now there are other Greeks. There's a whole list of what are called second tier Greeks, and technically speaking, you could create Greeks for all kinds of things. You're just trying to say how sensitive is something in relation to something else. The problem is that they're probably not that useful. So these are the ones that you definitely have to know as options traders. Now, before we get started, super important right here. One of the big mistakes that people make when they're interpreting these Greeks, you have to remember this assumes that all else is being held constant. So for example, we're going to find out that Vega is for volatility. How sensitive is my options price to a change in volatility? Well, that's a hard question to answer because if volatility rises, chances are stock prices are falling. And so the number that you see on your broker's platform is probably not going to be valid, not because it's mathematically incorrect, but because we have to assume that nothing else changed. And again, in the case of rising volatility, that's probably not going to be true. So just make sure you keep that in mind that whenever you're interpreting any of the Greeks, it assumes that all of the others are held constant. So let's start off with the first one on the list, delta. Delta shows how sensitive an options price is to changes in the stock's price. So most people know that a call options price is going to go up, generally speaking, as the stock price rises. Well, that's good information, but what's a better question? The question you'd really like to know is how much. Is it going to rise 5 cents or is it going to rise $10? Just knowing that it rises doesn't really tell the necessary information. We'd really like to know how much, and that's what delta shows. Delta is usually shown as a decimal, such as 0.60, but because each contract controls 100 shares, you might see it on your broker's platform as 60. Also, a lot of times, if for no other reason for convenience, I'll just say it has a delta of 60 instead of 0.60. Now, it turns out that long call options, options you buy, have positive deltas, and long puts have negative deltas. So as we're going to find out that delta is simply measuring the slope of that risk graph. So if you just understand that delta can be thought of as how many shares of stock do you have, that's another way to interpret it. So if you have 50 deltas in your long option, that option right now is behaving like 50 shares of stock. And of course, that's going to change as other factors change. But right now, with a 50 delta, it's behaving like 50 shares. If you have a long put, it's going to have negative deltas. Because if your put option has, let's say, negative 50 delta, it's behaving like short 50 shares. That's what the negative sign means. But whether we have positive or negative deltas, this is an area that a lot of traders get confused. The thing to understand is that as the stock rises, delta rises. And you're going to find out why it's easy to confuse that. But just remember it's a direct relationship if it's a long option. As the stock rises, your delta rises. And of course, the reverse is true. If the stock price falls, then delta falls. So for example, let's say that we look at our broker's platform and we're looking at quotes for ABC stock for the 140 call. And it's currently trading for $3. You look on your broker's platform and it shows that there is a delta of 60 or maybe 0.60. So what exactly does this mean? How should we interpret it? Well, if the stock right now is 140, and if it makes an immediate change, that's also important. Can't happen next week or 6 months from now. We're assuming it makes an instantaneous jump, all things being equal. So let's say that the stock rises to 141. We would expect that 140 call to pick up 60% of that $1 move, or 60 cents. And so we would expect that $3 option to trade for about 360. Even though the stock increased a buck, we shouldn't expect our option to increase from 3 to 4. So another interpretation of delta is that it's the percentage change of the change in the stock's price. If the stock went up 50 cents, we would take 60% of that, or 30 cents. We would expect that call to be trading for $3.30. So even though we often talk about delta in terms of the stock making a full dollar move, that's technically too big. But no matter what stock price you want to assume, assuming it's at least fairly small, you're just taking 60% of that change. Now again, little caveat here, you have to be careful. This is because we have other Greeks. And if you want to assume that the stock goes from 140 to 150, a $10 move, you shouldn't say that you're going to pick up 60% of that, or $6, because gamma, as we'll find out, is going to change this delta. So that's a really important concept to understand, that we are talking about reasonably small changes in the stock's price. So again, most traders assume a full dollar change, when technically speaking, that's really too much. On the way down, we can work it in reverse too. If the stock falls a buck to 139, that's a $1 decrease. So we should pick up 60% of that decrease and therefore lose 60 cents. We would expect that this $3 call should be trading for about $2.40. Okay, so where are these measurements coming from? When your broker's platform says it has a delta of 60, where is it getting that? Well, again, it's just simply a measurement of your risk graph. So look at the gray line. We've talked about these risk profiles before. The gray line is the current curve. Let's say it has 30 days to expiration. The black curve down here is at expiration. So deltas are real easy. You're either delta 0, you're just dead flat if the stock is at the strike or below, or you're delta 1. You're on this 45-degree line right here, meaning that your call is behaving exactly like shares of stock. But prior to expiration, that's not true. And this is where we need to have a pricing model to actually calculate what these options would be worth. So you should be able to see, if you understand the basics of math, or if you've ever had basic algebra where you're doing the equations for lines, it doesn't matter where you're measuring this black line. It's always going to have a slope of 1, meaning that for every dollar the stock rises, your call's going to rise $1. For every dollar that the stock falls, you're going to lose $1 in that option. But prior to expiration, it's not a straight line, it's curved. And that causes problems. So what they do is they're saying, all right, well, we can't say what the angle of this line is at various stock prices because it changes. So think of it like snow skiing. Up here, you're on a very steep part of the mountain. You're going very, very fast. Down here, you're basically dead stopped. You have a delta of 0, or at least very close. And if this is delta 0 and this is delta 1, behaving just like shares of stock, you have to be somewhere between 0 and 1 on this gray line. So what they do is they say, all right, let's take a very small range of stock prices, maybe down here, let's say between maybe 91 and 92. And they just measure that as if it's a straight line. Now again, technically speaking, this is way too large of a range, but it's done just so you can see what's happening. And they're going to say, what's the angle of this line? And they'll say, all right, mathematically it comes out to be 0.2. And that means that for every dollar you increase, this line only lifts up by about 20% of that, or 20 cents. So we would say the delta is 20, but only in this range. Now, of course, your option is going to be very cheap down here, but if the stock rises $1, it's going to pick up about 20 cents. But notice that as the stock price rises, these are stock prices out here, as we move along this line, we're moving up this gray line. And so maybe in this range, very small range, we measure it and we can see that the gray line is a little bit steeper. And we measure it and we say that it's 35. Well, now your call option is behaving like 35 shares of stock, not 20. We move up the line a little bit more, maybe closer to at the money, and maybe we're going to find it's going to be a delta roughly of 50. Line is getting a little steeper. Stock price continues to rise. What happens? Up in this range, we're going to be maybe a delta of 85. And then if we get really deep in the money, then we're going to be delta 1. That's the only time you're going to be delta 1 is if, relatively speaking, you are deep in the money, which means we could either be very close to expiration, but only be slightly in the money because there's just not a lot of time for it to fall out of the money. That's also going to be a delta 1 option. If this is a 2-year leaps option, you might need to be another 30 or 40 points in the money before that's delta 1. But that's why it's important to have the pricing model show you where you are on this curve. How sensitive is your call option to the next dollar move in that stock's price? That's what delta is going to tell you. Now, the same idea works for put options, but remember we have negative numbers. We're leaning out this way to the left. If you're short shares of stock, you would be on this black line. But let's say with 30 days to expiration, you're on the gray. So it's the same idea. Down here, we're very flat. Look at that very small red segment. It's just leaning to the left, so that's what the minus sign is telling us. It's behaving like short shares of stock. So now it's telling us that if the stock price falls, let's say $1, we're only going to pick up about 20% of that, or 20 cents. As the stock price continues to fall, that line's getting a little steeper, but in the negative direction. It's pointing out this way to the upper left side of the chart. As we get towards at the money, that little red segment is getting a little steeper. We're now about minus 50 deltas. As the stock price continues to fall, now maybe we're going to be minus 85 down here. And only if that put option goes super deep in the money are we going to be delta negative 1, in which case that put is behaving exactly like short shares of stock. But where are you right now? Or where will you be tomorrow? Or if volatility changes? It all comes out in the wash in the pricing model, and that's why it's important to understand what your delta is. It shows you how sensitive that call or put is right now to the next dollar move in the stock. Now, also a little quick word about the math of this. Earlier I said that whether you're talking about a call or a put, as the stock price rises, your delta rises. And this is where people get tripped up. They'll say, in this case, I have delta minus 50, and so as the stock price rises, I now have, let's say, delta minus 35. And they'll say that's a decrease. I've gone from 50 to 35. Well, not really. You're dealing with negative numbers. And remember, when you have negative numbers, the bigger the size of that, the smaller the number. So negative 50 is actually a smaller number than negative 35. So just remember that as you're moving to the right, whether you're talking about calls or puts, those deltas are going to increase. As you move to the left, whether you're talking about calls or puts, the deltas are going to decrease. Moving from minus 0.85 to minus 1 is a decrease in your delta. All right, so what about gamma? Well, gamma simply measures the rate of change of the delta. So this is the only Greek that doesn't measure the change in the option's price. It's measuring the change of your delta, and sometimes it's called the delta of the delta. It does exactly the same thing that delta does for your option's price, but it's now talking about how your option's delta is going to change. And another way to understand this is that it measures the option's curvature. So in that previous slide, we saw that that gray line, that current curve, is curved. And if you're operating in an area that's got a bit of curvature to it, there's going to be a lot of gamma. If you're in an area that's fairly flat, fairly straight line, then there's almost no gamma. Now also, if you have long options, Whether it's a call or a put, you bought it, you have positive gamma. And positive gamma is a benefit. That's why you must pay for it. But the thing with positive gamma is that your delta increases as the stock price increases, and conversely, delta decreases as the stock price decreases. And that's true for calls or puts. So what is gamma measuring? Where does that come from? Well, let's go back to a similar slide that we saw before. We're on the current curve here in gray, and let's look at a really tight range. Let's say maybe right around 100, we measure and find that we have a delta of 50. But if we go just a little bit higher, let's say maybe to that next stock price, maybe at 101, we measure and we get a delta of 0.52. We'll notice that delta has increased from 50 to 52. So that's gamma. We know that gamma would be 0.02. So that's just telling you on your broker's platform, if you have a delta right now of 50, but gamma of 0.02, then if the stock makes an immediate $1 move, all else being equal, that delta is going to go from 50 to 52. You are manufacturing deltas on the way up, but the math also works in reverse. If we're at this point first at 52 and we drop down here, we've subtracted 2 deltas. So this is where the insurance policy is coming in. If the stock moves against you, which is to the downside for a long call, notice that the gray line is starting to flatten. It is starting to shed some of those deltas, or in other words, sell some of your shares for you automatically. And that's why there's such a big benefit of having positive gamma and why you only get it when you buy an option. So what if you're way down here where there's not a lot of curvature? You can see in the center here we've got a lot more bend than we do out here. Well, out in this range, you know that your gamma is going to be very low, very close to 0. And up here, where that gray line is fairly straight, you also have gamma 0, or at least very low. It's only when you're close to at the money or near the money that you're going to see some sizable gamma. Gamma will always be maximized at the money. All right, let's move to the next Greek on the list, theta. What is theta telling us? Well, we all know about time decay. If you buy an option, its price slowly bleeds away over time, or if you sell an option, it is slowly appreciating over time. Well, that's good information, but what's the better question? The better question is, by how much? If I have a $3 option, is it going to lose 5 cents between today and tomorrow, or $1.50? Well, that would be some pretty good information to know, and that's what theta is showing you. It measures the decay in the option's value over time. It answers the question, how much will my option lose between today and tomorrow? Now again, technically speaking, and this is true for all of your Greeks, this is really too big of a range to do a full day's passage of time. But it makes for a convenient definition. But that's why if you're using pricing models, you might be off by a little bit if you're using a full day's passage of time. So in other words, I've got 30 days to expiration. How much is my option going to be worth if I have 29 days? And however much that option loses, that would be your theta. So if you have long options you've purchased, you will have negative theta. All else equal, they're going to lose value over time. Now, another super important idea to remember, I've talked about this in previous videos, theta is a characteristic of an option. It's not a risk. This leads to a lot of bad decisions. People think that theta is a huge risk, and that's why I've got to sell my option before I have too much theta kicking in. But remember, risk is defined as an unknown, and time moves in one direction at one speed. It's absolutely one of the few things that we know with certainty in the options market. So you really shouldn't see it as a risk. It's more of a characteristic. All right, so let's say we're on our broker's platform. We're looking at quotes. We see the $100 call trading for 3, and it tells us that the theta is minus 0.05. This assumes that we are buying the option. All of your Greeks are assuming a long option. If you want to know what it's going to be if you short the option, if you sell this option for 3, it's going to be positive 5 cents. You're just the trader on the other side of the trade. So how do we interpret theta? What this means is that if you buy this option, everything else stays the same. Stock price is the same, volatility is the same, everything else stays the same. just the passage of time. How is that going to affect my option? Well, it's going to knock off about 5 cents. So tomorrow, all things being equal, we would expect that that call would be worth $2.95. And of course, then you're going to get a new theta. All of your Greeks change all of the time. But your theta, just like gamma, will be maximized at the money. That's actually true for all of your Greeks with the exception of delta. Delta, when it's at the money, will be roughly 50, and it's maximized when it's super deep in the money, when those options go very near delta 1 or delta negative 1. Okay, so just to be clear, if you sold this option, let's say as part of a covered call, you would expect that position to appreciate by 5 cents tomorrow. Okay, moving right along to the next one on the list, Vega. Vega is not a Greek letter, so don't bother looking that up. The Greeks don't have a letter V, so they just kind of made this one up to sound like a Greek letter. But it was chosen to measure the change in the options value for a 1 percentage point change in volatility, meaning that volatility rises from 20% to 21%, or from 37% to 38%. That's what it means for a 1 percentage point change in volatility. It does not mean take 1% of that number. You're just adding 1 or subtracting 1 from that current implied volatility number. So I think most of you know that long options like volatility. If volatility rises, all long options will increase in value, calls and puts. Again, that's if you purchase them. So Vega is simply answering the question, how much will my option increase if volatility rises by 1 percentage point? That's really what you'd like to know. So the thing to understand about Vega is that long options are positive Vega. If you buy an option, whether a call or a put, you'd love to see volatility just crank up. Why is that? Well, as volatility rises, it means that there's a better chance for the stock price to rise or to fall. So if you have a call option and the stock price falls, well, you're not really damaged outside of what you paid for the option. Those payoffs are zero. But you are greatly benefiting from increases. And for puts, it's same idea, just in the opposite direction. If you own a put option, you would love to see volatility cranked up because that means the stock has a better chance to fall, which is great for your long put. But if the stock prices rise, those put payoffs are zero. So you're not really harmed outside of what you've already paid for the option. So when it comes to long options, you're thinking, go volatility. You definitely would like to see volatility cranked up. And that's why long options have positive Vega. And then, of course, short options would have negative Vega. If you're short an option, you want to see those stock prices freeze. You don't want to see conditions change to where those stock prices have a better chance of moving. Well, again, let's go back to a broker's platform. We're looking at the $100 call, trading for 3, and we look and it shows us that we have a Vega of 0.10. We also see that the current volatility is 20%. And what this means, this is the volatility number that you would have to feed into a pricing model to get the current option price. So if volatility rises from 20% to 21%, we would expect it to trade for about $3.10. Now again, as I mentioned on one of the earlier slides, we're assuming everything else is constant. If volatility is rising, it could be because the stock price is falling. So very rarely is everything constant in the market. So you have to be very careful about how you're interpreting these Greeks. And then, of course, the reverse is generally true, that if the volatility falls from 20% to 19%, we would expect this option to lose Vega, or 10 cents, and trade for about $2.90. And now finally, last one on the list, what is rho? Well, rho is the Greek chosen to measure the rate, or the change in the interest rate. So it measures the change in the options value for a 1 percentage point change in interest rates. So rho answers the question, how much will my options price change if interest rates change by 1 percentage point? If you buy a call, long call, you have positive rho. They are positively sensitive to interest rates. As interest rates rise, call options are going to appreciate. And if you have put options, they will have negative rho That's assuming that you have purchased the put. So how should you interpret rho? Well, we're back on our broker's platform. We're looking at the quotes. We see the $100 call trading for 3, and we see that it has a rho of 0.02. So if the risk-free rate, let's say, is 5%, and rates instantly rise, remember, we're not talking about a long period of time. This is an instantaneous rate of change. Interest rates go from 5% to 6%. We would expect this call to go from 3, it's going to pick up rho, should trade for about 302. So not super sensitive to interest rates. And conversely, if the rates fall from 5% to 4%, this call should lose rho and trade for about 298. Now, a couple of points about rho that's really important to understand is that remember that when rates change, stock prices are affected as well. So if the Fed comes out and makes, especially if it's a surprise move from 5 to 6%, don't expect your call price to rise. Chances are stock prices are falling. We're assuming everything else is the same. And the second point to understand is that rates generally don't rise in full percentage point moves or in 100 basis point moves. They are usually done in quarter point moves. So if you're looking on your broker's platform and you see a rho of 0.02, you could probably divide that by 4 and say that the sensitivity is more like a half a cent. Just not real sensitive at all. Another point to understand about rho, just because the U.S. generally has low interest rates and stable interest rates does not mean that rho cannot be a very big risk. If you are trading currencies and you are short a currency in a country that has runaway inflation, rho could be the most devastating Greek ever known to man. So you just have to understand that for the U.S., for options, rho is generally not a very big factor. Could it be? Sure. If you have a 2-year leaps option or a 3-year leaps option on a $1,000 stock and rates are going quickly from 0% to 3 or 4% like we did coming out of COVID, sure, that can greatly increase the value of those calls and also greatly decrease the value of those puts. So I hope that helps you to better understand these Greeks that you're seeing on your broker's platform and how to interpret them. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.